Hey guys, Omar Khan here with Theta Trading, and we're going to start doing a series of videos to get you guys back into what we call the Theta Trading way. All right, so let's take a look at today as to why most options traders actually lose money. All right, so there's five different reasons why options traders actually lose money, and the biggest one I'm going to leave for last. Okay, the first one we're going to talk about today is going to be transaction costs and bid ask spreads. Now, transaction costs can get really out of control. And what I mean by that is if you are doing complex option strategies, you're doing a lot of contracts, right? So, for example, if you're doing something called an iron condor, right, which is two simultaneous credit spreads on either side of the coin, meaning some calls and some puts. And I'll get more into what each of these strategies are in future videos, but that is a big thing. Now, another one is bid ask spreads, right? So high frequency traders tend to incur significant fees, poor execution. So you're not getting great execution if you're doing this potentially, not always, but potentially, and it totally kills your profitability. All right. Now, another huge one, okay, is neglecting implied volatility. All right. So implied volatility is how much is the market fluctuating up and down. If it's going up and down a lot, that means the more that you're getting paid to sell options. And ultimately, that's what you want to do. You want to sell options. You don't want to buy options. But if you don't understand how implied volatility works or IV crush works, which is implied volatility crush, you're going to get absolutely killed on these options. So there's again many reasons why we sell options and don't buy options, okay? So buying options when volatility is high means paying a premium. You're paying a huge amount which is going to go down in value if the market calms down a little bit. So think about it as the stress indicator. So if implied volatility is high, that means the stress in the market is high. And if it's high, that means you're going to pay a lot of money because you're paying for insurance. Okay. So when you're neglecting to look at implied volatility, if volatility drops, after like an event like earnings or like a geopolitical event like what's going on, um, oftentimes in the world, this collapses. Okay, so let me give you an example. All right, so for example, if you're selling an option or buying an option on something, and all of a sudden an unknown, uncertain event goes away. Okay, so you're buying an option on something, whatever that option may be, and all of a sudden now it's worth way less money than it was before. Well, that means you're going to lose a lot of money because you didn't necessarily sell the option. You may have done some complex option strategy, and there you go. Now you're in a whole different position. Actually, getting back to the first one, transaction costs and bid-ask spreads. Transaction costs can get really, really high. So if you're doing like, for example, like I said, an iron condor or a credit spread, you have to do a lot of contracts. You have to sell a lot of contracts or buy a lot of contracts in order to execute your strategy. So for example, if I'm selling a credit spread, right? And I'll get more into what all these topics are because we'll be doing a whole series of what these different topics are in the near future. If I sell an option, okay, and all of a sudden I'm selling 30 puts, buying 30 calls, well, all of a sudden that's going to cost me a lot of money, right? Because you think about how much that costs per option, even the best possible way, you're still going to be paying at least a dollar, 25 an option. So that works out to $75 for that trade, for that one trade. That's big. That's huge, in fact. Okay. And now, if you look at the bid ask spread, as we were talking about earlier, well, the bid ask spread could be another huge deal, meaning how much is someone willing to buy for and how much is someone willing to sell for? Well, that can change drastically. It could be 1 cent, 2 cent difference, or it could be a 5 or 10 or 15 cent difference. And if it's a 5 or 10 or 15 cent difference, well, that's going to again chew into your potential profitability a lot, right? But the bottom line happens to be the same thing. The bottom line is simple. The bottom line is those who sell options generally tend to win as opposed to those who buy options. Okay. So you want to be on the selling side. Now, another one here is emotional trading. Okay. Now, we are all susceptible to emotional trading in terms of not just emotional trading, life in general. We're all susceptible to emotions. Okay. So if you're having a good day, a bad day, whatever it may be, that may greatly influence your ability to trade, right? Greed plays a huge factor in this, okay? So, are you holding on too long? Are you selling too early? That all depends because it really depends on how greedy or emotional you happen to be that day, that week. But it's human nature. Human nature is to be greedy, okay? I remember my first trade ever. I did a long time ago, back in the late 90s. And I turned $5,200 in an RSA call. It was called RSA. It was a technology company at the time. I believe they're still around now, but I'm not sure. And I turned $5,200 into like $65,000. But I never cashed out. And that $65,000 went all the way down to zero. All the way down to zero. Why? Because I got greedy. Okay. So emotional trading is a big deal. So whether you're having a good day, a bad day, it greatly influences your ability to trade profitably for a long period of time. And it will always influence your ability to trade for a long time unless you learn how to control that emotion, which takes a long time to learn how to do, right? Now, another one here, okay? Over leveraging or a lack of capital. Okay, so now over leveraging, what does that mean exactly? Well, that means you're playing with a lot more money than you have. Okay, or a lack of capital. If something goes wrong, you can't put more money in there to sustain the trade. Okay, so when you trade, you're trading on something called margin, right? Which means they'll lend you money and you can trade on it as such. So if you put in, let's say, $1, they'll let you trade with $3. Okay. But oftentimes, if the trade goes against you, which it can easily in the short term, maybe you have to put another dollar in and you can't. And all of a sudden, you're busted out of the trade and you're wiped out. Okay. And over leveraging means that, again, you're trading with a lot more money than you have actually in your account. Okay. So when you trade options, you're using something called a margin account. There is no other way to sell options or trade options or buy options. There's no other way. Okay. So when you're over leveraging yourself, that means you're taking a small amount of money and you're looking to turn into a large amount of money. And that is not an easy thing to do, right? Because if something goes wrong in that trade, even in the short term, not necessarily the long term, the trade could work out for you in 2 weeks, 3 weeks, 4 weeks, a month from now, whatever it is, because generally trades happen to be for a short period of time. But in a very short period of time, if that trade happens to go against you, are you able to add more money in if you need to? And most people can't, and they get busted out of that trade. Okay. Now, another one here is high risk trades with low probability. Okay. This is a big one. What I mean by high risk trades with low probability, high risk trade means that if you are looking to make, again, a large amount of money with a small amount of money that you're using yourself. Okay. And this is the biggest one out of all the ones we've discussed so far. This is the biggest one. Okay. So you think Google's going up, or let's actually use Tesla as an example. You think Tesla's going up another $50 a share. Okay, well it might. Okay. So what you do is you buy a call option on Tesla. Well, that call option might cost you a little bit of money. So let's say Tesla's trading at $400 a share. and you buy a call option at 425 and it costs you $1 a share. And again, these are hypothetical numbers, okay? That means for every dollar it goes above 425, you make $1 a share. So if it goes to 450, you turn $1 into $25. So you made an absolute killing, okay? Most options investors or traders do this. They're looking to turn a small amount of money into a very large amount of money. So they buy cheap, far out of the money options, and I'll explain all this stuff is in further videos. Out of the money means the difference between 400 and 425 with a very low probability. That's something called delta. And again, we'll discuss all these things. It rarely becomes profitable. However, every so often it does. And this is the biggest tendency for people to do. They'll look at making these trades, it doesn't work out for them, and they lose everything. Okay. So when you're buying options, which most options investors or traders happen to do, is they're looking to turn a small amount of money, like I said, into a large amount of money. And they happen to buy an option. And that option goes the wrong way against them. Well, what do? Okay, so they may be over leveraged, meaning they may have used a lot more money than they have. They cannot add more money in to sustain that trade to see it out, right? And then they lose all their money. Okay. Now the biggest one of all, okay, is something called theta. Okay. That is the time value of money, and that is working against you. And when that's working against you, you have a big problem on your hands. Okay. Now that will always work against you when you are an investor. Okay. Now, what exactly is theta, and why did we decide to call our company Theta Trading? Well, there's a very specific reason we decided to do that. Well, theta is the concept of an option's decay of time value on a daily basis. So let's say I buy an option today. Okay. Let's say I buy an option today on Tesla. And I'm looking for Tesla to go from 400 to 450. Okay. Well, every single day, there's less and less likelihood of that happening, right? Well, that is theta. So every single day, the value of that option keeps going down every single day. If I buy that option at $1, and the next day it's worth like 95 cents, and the next day after that it's worth 90 cents. The reason why is that? Well, it's because every day that passes, there's less time for that to potentially happen. And that's the concept of theta. Okay? So again, I want to explain again what theta is. Okay, so theta is the most important option determinant of all. Okay, and again, if you buy an option, which most people tend to do because they want to turn a small amount of money, they want to hit it big. It's like kind of going to the casino. It's not a great idea as an investor. However, people have the tendency to do this. Okay, so I'm looking for Tesla to go from 400 to 450. And I buy a 450 call option on Tesla. Okay. Well, let's say I pay $1 for that. And I buy it for 30 days. Okay. So I'm looking for Tesla to go from 400 to 450 within 30 days. That's not a lot of time. If it doesn't go from 400 to 450 in 30 days, well, if it goes in 31 days, doesn't matter to me anymore because I'm out. Right? So what the concept of theta is the time value decay of an option. So every single day, the value of that option will decline. And if you're the buyer of that option, you are swimming upstream. So you look at a salmon which swims upstream. It's much harder than a salmon swimming downstream. Okay, and if a salmon is swimming upstream, it is fighting the value of that time every single day. So again, you buy that option on day one and you're all excited. You're like, okay, I got this. You buy it for $1 and nothing happens after a few days. Now it's worth 90 cents. Well, why is it worth 90 cents? Let's say 3 or 4 days have passed. Well, now that you have that much less time, because remember, you only bought it for 30 days. So now you have that much less time for that option to do what you think it's going to do, which is hit $450 a share. So now it's worth less. Now a couple more days go by. Now it's worth 85 cents and 80 cents. Because again, there's less time for your actual position to come true. And that continues to happen. Okay. And this is exactly why we sell options and not buy options. So, just to recap, guys, these are the reasons we decide to sell options and not buy options. Okay. First, transaction costs and bid-ask spreads. When you look at transaction costs, especially when it comes to um, um, more complex strategies like iron condors, they can be extremely high per trade. I've had options trades where they cost hundreds of dollars per trade. Per trade, right? And that can really eat into your profit, okay? Bid-ask spreads, which is the difference between what someone's willing to pay for an option and someone's willing to buy an option for. That's called liquidity. That also happens, okay? Now, not understanding the concept of implied volatility. Implied volatility is probably the biggest determinant of what an option value actually costs. Okay. Essentially, what it means is this: it's pretty simple in layman's terms. The more a stock goes up and down, okay, the more uncertain it is. And the more uncertain it is, the more that option may cost. Now, if you're looking to sell an option, that's fantastic for you, especially if you're willing to buy that option at a cheap price or buy that stock at a cheap price, right? Now, that is another thing that people always neglect, or not always, but oftentimes neglect. Emotional trading. Emotional trading, again, is when you are looking to, okay, oh, I lost this trade, I lost that trade, I lost that trade. I'm going to get the next one. Well, will you or will you not? You're having a bad day. Is that a great idea? It can happen easily, okay? Over leveraging, okay? Using way more money than you have to play with and not being able to put more money in, which is lack of capital, okay? Now, high risk bets on low probability events. Now, this happens, this is probably the biggest one that I've ever seen. It's like someone says, you know, I think Tesla's going to 450, okay, next month. And you decide to buy an option for 450 and the stock is currently trading at 400 and you only have 1 month for that to occur. Yeah, you're not going to pay a lot of money for that option. And if Tesla goes to $500 a share, you make an absolute killing. But it's a low probability event. And people tend to do this very often, okay? And the last one is, again, just to reiterate, is time decay. Every day, the value of an option is worth less and less and less and less. And that's because every day that passes, there's less likelihood that what you wanted to happen will happen. That is the concept of theta. This is exactly why we call our company Theta Trading, okay? Because we don't swim against the current when it comes to theta. We swim with the current when it comes to theta. All right, guys. Thank you so much for watching this video. If you like it, please hit the like button, and I will be doing a lot more of these videos in the near future, and we will talk to you all very soon. Take care. Bye-bye.